It wasn't a market correction. It wasn't a temporary glitch in the algorithm. It wasn't even a standard geopolitical panic. It was the mechanical execution of a repricing event that history warned us about centuries ago. The headlines focus on the noise. They talk about diplomatic tensions. They debate the fairness of trade policies. But the signal is in the ledger. $420 billion gone, evaporated from balance sheets in a matter of days. The pattern is unmistakable. When a global power weaponizes access to its market, the arithmetic is merciless. 70% tariffs are not a tax, they are a blockade. They sever the arteries of supply chains that have been built over 40 years, and the market knows exactly what comes next. Input costs rise, margins collapse, capital flees to safety. This is not a prophecy, it is a historical constant. The incentive is always the same: to inflict pain on the rival's domestic economy. Until the political cost becomes unsustainable, the risk is that the mechanism spirals out of control, creating a feedback loop of inflation and stagnation that destroys wealth faster than it can be created. Think about what that means. It means the value of your portfolio is not determined by earnings, it is determined by the geopolitical risk premium. To understand why this wealth destruction was mathematically guaranteed, we must look at the empires that walked this path before, because the road from trade war to capital flight is paved with the same three failures every single time. Let's look at the Spanish Empire. The year is 1590. King Philip II controls the global flow of silver, but the costs of maintaining dominance are crushing. Wars in Flanders and the protection of trade routes drain the treasury. So the crown chooses the monetary shortcut. They impose heavy taxes and trade restrictions to keep bullion within the borders. The result is the price revolution. Inflation tears through Castile. A peasant farmer sees the cost of grain triple in a single decade. The merchant class is suffocated by the new levies. Capital flees from productive enterprise into tax-exempt land and titles. The economy hollows out from the inside. The middle class is priced out of existence. The empire defaults 4 times. The wealth wasn't destroyed by an invading army. It was destroyed by the policy response to economic stress. Just like the Spanish example, the British Empire faced a similar reckoning in the 20th century. By 1930, won the cost of the Great War, and global depression rendered the imperial model unsustainable. The chosen shortcut was the abandonment of gold and the implementation of imperial preference tariffs. The goal was to shield the British economy from global competition, but the arithmetic was merciless. The resulting trade barriers fragmented the global market, leading to a decade of stagnation and erosion. The flight into hard assets accelerated, land prices held while industrial equity suffered, and the social fracture deepened for the working class. A dock worker in Liverpool didn't understand tariff schedules, but he understood that his wages no longer bought a week's worth of food. Just like the British declined the Weimar Republic in 1920, 3 offers the most extreme example. Faced with the crushing weight of war reparations and the seizure of the industrial Ruhr Valley, the government chose the ultimate monetary shortcut. They printed money to pay striking workers and subsidize industry while trade collapsed. The inflation that followed was not merely a statistic, it was a social solvent. A loaf of bread cost billions of marks. The flight into hard assets became a panic. With pianos in foreign currency becoming more valuable, the middle class was not just priced out, they were liquidated. The incentive to save was destroyed, replaced by the incentive to speculate or hoard. The pattern repeats in 7 distinct stages. Stage 1 is the trigger where a dispute escalates into economic warfare. Stage 2 is the retaliation where tariffs are applied with the intent to punish. Stage 3 is the cost transfer where businesses pass rising input costs to consumers. Stage 4 is the repricing where markets realize that lower margins are permanent, not temporary. Stage 5 is capital flight, where liquidity leaves the affected zone for neutral ground. Stage 6 is currency volatility as capital flow destabilizes exchange rates. Stage 7 is the wealth transfer, where middle-class purchasing power is permanently transferred to holders of hard assets and debt issuers. Just like the historical precedents we are watching this sequence play out in real time, the imposition of 70% retaliatory tariffs is not merely a trade dispute. It is stage 2 of the pattern. The $420 billion lost represents the market mechanically moving to stage 4. Investors are repricing the future earnings of American companies relying on global supply chains. The incentive for China is to demonstrate that the cost of containment is higher. The payoff for them is the fracturing of the dollar-based trade system. Current data suggests that specific sectors, Particularly technology and agriculture are bearing the brunt exactly as the arithmetic predicts. The hidden mechanism here is not the tariff, but the sudden realization that frictionless profit is over. Some historians note that the U.S. market is robust enough to absorb these shocks. They argue that consumer spending will offset loss and that the economy can pivot internally. However, this ignores the fundamental nature of the mechanism. When input costs rise due to tariffs, the efficiency of the entire system degrades. Under these constraints, the rational move for capital is to seek yield elsewhere or hide. The risk is that the consumer, already stretched, cannot absorb the new price floor, leading to demand destruction rather than substitution. The arithmetic of 70% tariffs means that for every dollar of revenue, a significant portion is claimed by geopolitical friction. The trajectory leads to three potential endgames. The first is controlled decline, where blocks solidify and global growth slows permanently. The second is chaotic collapse, where repricing triggers a liquidity event in the bond market, forcing central banks to intervene with injections. The third is reset and restructure, where a new monetary agreement is forged to accommodate the multipolar reality. The only variable is timing and pain. Subscribe to the channel, educate yourself, build resilience in your personal economy, pay attention to the data, not the headlines.